Okay, so let's just go ahead and let's take a look at the slides for Chapter 4B. Okay, now I have taken 4A and 4B and broken it into two separate lectures because 4A, if you look at all of Chapter 4, they kind of mush together the discussion of revenues versus the discussion of how do we do our budget to then lead into our expenditures. So rather than kind of mush that all together, I thought it's a little more digestible if we split it into two separate sections, 4A, 4B. Okay, so what we're going to do in 4B now is start to look at the process of A, budgeting for our spending, and then doing the actual spending. Now, this is the part of the class that sometimes gets folks, the revenue recognition stuff's a little bit complex, but I think you saw after you apply it, it's not that bad, right? This part of the class starts to give folks some concern, students some concern sometimes, because we're going to be doing budgetary entries for which you may have absolutely no previous exposure to. Okay, so we're going to be sort of in many ways breaking new ground. It's going to almost feel like introductory accounting to you, and that I'm going to tell you, here's a transaction, this is the journal entry that you make. And you're going to say, I've never done anything like that before. That's kind of weird, right? The good thing is we're still going to use debits and credits. Okay, where my trouble with my introductory students is I'm still fighting them to say, how do you increase cash? Credit it. No, you debit it, right? So we're not going to mess you up that bad. We're still going to be using debits and credits in a manner that you're familiar with, but we are going to be looking at how do you account for not just current transactions, but what? Transactions that are going to happen in the future. Okay, we'll be doing the budgeting for that. Okay, so our first job here is to understand our budgetary accounts. Okay, now you know that we have revenues and we have other financing sources, right, on our statement of revenues, expenditures, and change in fund balance. Okay, you know that we have expenditures and what? Other financing uses, right? So we have money that we're going to be having coming in. We're going to have money that's going to be going out, right? And what we have to do in our budgetary accounting is sit there and actually estimate what we think these resource inflows and outflows are going to be. Okay, so if it is going to be a budgetary account, instead of calling it revenue, we call it estimated revenue. Because we're saying this is what we think our revenue is going to be, what, next year or whatever. If we're talking about other financing sources, we don't just call it other financing sources, we call it estimated other financing sources, because again, we're projecting what we think is going to happen in the next year, right? Okay. Now, when we get to the amounts that are going out, our other financing uses and our expenditures, we don't just call it other financing uses, we call it estimated other financing uses. And then you finally get to this term appropriation. And appropriation is like, I wrote in, like estimated expenditures. But we don't call it estimated expenditures, we call it appropriations. Now here's why we call it appropriation. A government cannot spend money unless there has been an adopted legal authority to spend that money. And that legal authority to spend money is called an appropriation. So appropriation is what? The authority to spend. So once we get that authority to spend, that's what we're estimating we're going to spend, but we don't call it estimated expenditures, we call it what? Appropriation. Okay? Now, do you remember a couple years ago, maybe you were paying attention, maybe you weren't, that they shut down the federal government? They shut it down. And they said, well, we shut it down because we don't have the money. Okay, and you thought, well, wait a minute. You mean to tell me the government's broke? I mean, they're still collecting tax from my check. Don't they have the money that they took from my check last week? Okay, and so what happens? They had the money. But what they didn't have is the legal authority to spend the money. They did not have the appropriation. So if you don't have an appropriation, you can't spend money. And so that's why they would do things like send federal employees home. And, everybody's like, shut the government down. Yeah, shut it down, until they say, well, don't shut the park down. Well, that's part of it, right? Hey, where's my Social Security benefit? Sorry, we're not going to pay it because we can't spend money unless we have the legal authority to do such. So it's not just a matter of sending a bunch of useless federal employees home and not paying them. It affects things like benefits, everything else, right? Okay, so let's look at these budgetary accounts. Let's say them together. We have not revenue, but estimated revenue. Not other financing sources, but estimated other financing sources. Not other financing uses, but estimated other financing uses. And not expenditures, but appropriation, right? And we don't call it estimated expenditures, but that's what it's like. Okay? Now, we're going to see that we're going to be using an account called budgetary control. Budgetary control is a placeholder for what we're thinking our fund balance will end up being. So if we have more estimated revenues and estimated other financing sources than we do appropriations and estimated other financing uses, we're going to have some money left over, aren't we? That money that's left over theoretically should increase our fund balance because our change in fund balance will be positive because we'll have what? We'll have more revenue and other financing sources than we do expenditures and other financing uses, right? So we put it into a temporary account. We don't credit it straight to fund balance because we don't know for sure whether that's going to be the amount of our change in fund balance for the period. We park it in an account called budgetary control. Okay, and then anytime we order goods, we're going to have to debit an account called encumbrances, and we will credit this account called budgetary control. We do that to put a placeholder on any of our appropriations saying, hey, we have already ordered something under that budget authority, so that budget authority is used up. We call that encumbrance, and we will use a parking lot called budgetary control until we actually receive those items. Okay? All right. So this is just giving you a high level view, an outer space view here of the budgetary accounts. What we're going to do is go through and see how we will use these now in actual journal entries, starting with the beginning of the year budgetary entry, doing during the year budgetary entries as we actually order goods and services using our encumbrance accounting, and then what we do at the end of the year to close these budgetary accounts. And we'll also be looking at how we record actual transactions alongside those. Okay? All right, so this is what we do at the way I had written this, it went off the screen at one time. Somebody gave me some advice as to how to do this, and it was bad advice. So that says beginning of year. Okay, at the beginning of the year, we will sit there and we will say, and this is the people working for the government, hey, Harv! Hey, Harv! Yeah, what do you want, Bill? How much revenue do you think we're going to make next year? Oh, I don't know, 500,000. And they debit estimated revenue 500,000, right? Now, I guess the process is a little more sophisticated than that, but it is somewhat of a guess, isn't it, as to what they think the revenue is going to be? So they debit estimated revenue 500,000 because they think that's what their revenue is going to be. Now, what happens? The legislature appropriates money that we can spend. We can't spend money without the appropriation, right? Now, we don't credit estimated expenditures, we credit appropriation. But that's how much money we have the legal authority to spend. So we credit that. The difference between what we think we're going to take in as revenue and what we think what we're authorized to spend, that difference goes to budgetary control. And that's the credit to make this journal entry balance. Now this government is estimating what? Estimating a surplus, aren't they? They're estimating that some money will be left over after they have collected all their revenue, spent all the money that they have the legal authority to spend, their appropriation. What they're going to be left over with is what? This surplus. What happens if they think they're going to spend more money than they're going to take in? So let's say that their estimated revenue, and you can see I wrote it in here, was only $450, and their appropriations, what they have authorized to spend is $500,000, this government's going to run a deficit, aren't they? And if it's a deficit, notice we debit budgetary control. So budgetary control could be a credit or a debit depending on whether this government's going to run a surplus or going to have a deficit, right? In case of the federal government, it's always a deficit, right? Now sometimes my students will say, well, I guess they didn't really want to have a deficit and the poor guys just ended up with a deficit. They passed a budget that legally required them to have a deficit because they don't want to raise taxes. They want to cut taxes, don't they? Isn't that what they just got done doing? Didn't they just get done cutting taxes? Did they cut your taxes? I don't know. I know that if you were going to inherit $11 million, they cut your taxes. And if you were going to inherit $11 million, my question to you is, what are you doing here? Okay? But assuming that, you're here listening to all this fascinating stuff at 7:18 on a beautiful Wednesday night, and you got all dressed up and went to meet the firms and all that, you probably aren't inheriting $11 million, okay? I'm just going to go with that, okay? If you are, my hat's off to you, okay? So, what happens? They cut taxes, didn't they? Particularly for people going to inherit all that money, okay? They cut taxes. So they cut the taxes, the revenue went down, but they don't want to face the political reality of what? If you cut taxes, you're probably going to have to cut out some spending. You can't add to the military during that time, which they did. You can't continue to pay the same amount of benefits out, which they did at that time. You can't continue to pay the interest on the debt, which you have to, etc., right? Okay, so that's how they keep ending up with this deficit every period. Okay, state and local governments do try to run a surplus. State of California runs a surplus. Okay, from time to time, governments will slip into deficit if it seems appropriate for whatever their long-term goals are. Okay, but again, the takeaway here from the accounting standpoint is what? If you're going to have money left over, you credit budgetary control for our surplus. If you have planned to spend more money than you plan to take in, you debit budgetary control for what we call a deficit. Okay? Now, you look at this information underneath, all this detail underneath. This is subsidiary level information. This is simply saying, well, for our revenue, these are going to be the sources of revenue. Licenses, taxes, whatever, right? Okay, so this is subsidiary level. This number adds up to 500,000. These numbers should add up to 450. This is the nature of the type of activities that we're going to spend money on. In this class, I will not hold you to subsidiary level discussion. I only want you to know what? The GL level. Notice I wrote GL up here. If I have estimated revenues of 500,000, what do I do? Debit estimated revenue. If I have appropriation of 450, what do I do? Credit appropriation. If my what? If my estimated revenues are more than my appropriations, I have a surplus, so I'll credit budgetary control. If my appropriations are more than my estimated revenue, I'll have a deficit, so I will debit budgetary control. With me so far? Okay, now, this journal entry maybe makes you feel a little funny, a little weird, because we're talking about revenues here, although they be estimated, and we're debiting them. We're talking about money we're going to spend, although we call it appropriation, and we're what? Crediting it. That's backwards, isn't it? Aren't you supposed to credit revenues and debit expenditures? Okay, well, what's going on? These are budgetary numbers, aren't they? And so what we will do is we will go ahead and we will create something called a revenues ledger. Again, I don't worry about subsidiary, so I cross the word subsidiary out. Revenues ledger, and there's our debit to estimated revenue, isn't it? And we put that there as a placeholder to track against our actual revenue. We're not going to mess you up that much in this class. Actual revenue is still a credit, just like you learned when you were 2 years old, right? Okay? And so what happens? Let's say that this government issues some fishing licenses, whatever. They get some cash. Fishing licenses, they're allowed to do the activity immediately, right? So we can take that as revenue, okay, using our revenue recognition rules. So we debit cash, we credit revenue for $40,000. when we enter this credit in our actual revenue, and I put actual in quotes because you don't have to call it actual, you could just call it revenue, but just to make sure we're all on the same page, actual revenue 40,000, this government knows now that it has what? 460,000 left to go, tracking against its revenue budget. So this is a useful tool, isn't it? You debit estimated revenue at the beginning of the year. You then do what? You then credit your actual revenue, just like you did when you were 2. Debit the cash, debit the tax receivable, whatever, like we were learning earlier in Chapter 4A. And you know you have 460 left to go, right? A little bit later, I don't know, they issue some more licenses. 50,000 cash comes in. They credit revenue 50,000. Now they know they've got 410 left to go, don't they? So this revenues ledger, by debiting estimated revenue and entering that as a debit, allows us to track against our actual revenue, which are credits. Question? Okay, good. Now you come over and let's look at how that works for our appropriations and our expenditures. Okay, so what happens? Under budgetary accounting, anytime you order a good, you have to make an entry that records that that budget authority has been encumbered. Now the reason they do this is that if I receive an appropriation of 450,000, I can only spend 450,000. I cannot spend 480. I can only spend what? 450. And if I spend more than 450, I could be, as a government official, personally liable for civil money penalties. So they will charge me what? A penalty. They don't throw you in jail. It's not like they give you the death penalty or anything. But they have a civil fine that they could fine government officials if they exceed their budget authority. So they don't want to exceed their budget authority, so they're going to record an entry against their budget authority so they don't over-order. So they don't go crazy and order all kinds of stuff and then, oops, we ordered too much. Now we have to pay for it, and we're going to go over our budget authority. Now we're going to be fined, right? So anytime you order goods, you make a journal entry. Do you do that in commercial? For orders? Typically not, unless you have a firm purchase commitment and the value of that item that you're committed to purchase drops, then you are required to take a loss and a contingent liability, blah, blah. Never mind. Let's just say no, okay, for our purposes right now. For government, we have to make an entry because we have to track against our budget authority, right? So anytime you order goods, you debit encumbrance, credit budgetary control for, in this example, 50,000 for a what? For a printer. That's a hell of a printer. That must be one of them 3D printers or something, right? Okay, so $50,000 for a printer. We debit encumbrance, we credit budgetary control. Now all we've done is order this thing, right? From the catalog, but we make a journal entry, okay? Then what? Then the thing comes in. And when it comes in, there was $500 of shipping charges that we hadn't anticipated initially. No problem. We can fix the world with a journal entry, can't we? So all we do is we reverse the original entry for the original amount. We debit budgetary control 50,000. We credit encumbrance 50,000. That's reversing that entry, isn't it? Right? And then we go ahead and we debit expenditure, credit an account called vouchers payable. Vouchers payable is like accounts payable, but in government we use the term vouchers payable because typically expenditures have to be approved on a document called a voucher. So we'll list all the expenditures and somebody will come in and sign off saying, yes, I'm cool with all these expenditures. So rather than calling it accounts payable, we call it a voucher payable, but it's like accounts payable. Okay? So we go ahead and we credit vouchers payable for the $50,500, debit expenditure for the actual amount. Yes, sir.
So imagine that you didn't have that shipping charge of $500, you still reverse it. And then,
If you didn't have the shipping charges of $500, you would still reverse it at the $50,000, debit the budgetary control, credit the encumbrance for $50,000. That essentially gets rid of that earlier budgetary entry, and then debit expenditure $50,000, credit vouchers payable for $50,000. Let's go the other direction. Let's say it came in at actually $49,000. we would go ahead and when we ordered it, we thought it was going to cost us $50,000. We debit encumbrances, credit budgetary control for $50,000. When the stuff comes in at an actual invoice price of $49,000, debit the budgetary control for $50,000, credit the encumbrance for $50,000, debit expenditure for $49,000, credit the vouchers payable for $49,000. Okay? Now, when you look at this, now we have an appropriations ledger similar to our revenues ledger. Then we have a revenue ledger. Now we have an appropriation ledger. And remember when we got the appropriation, we credited it, right? Remember I said it's a little weird. It seemed backwards. We're crediting amounts we think we're going to spend. That's because what? The actual expenditure will be a debit, won't it? Actual expenditure will be a debit. Okay? But what we do is we first debit, and I'm not trying to strike that out, guys. I was trying to underline it, but the lined up got weird. We first debit encumbrances, don't we? We debit encumbrances. And when we put that debit encumbrance against our appropriation, we know that we only have $400,000 of budget authority left, right? So if somebody were to run in and say, hey, we want to buy some for $430,000. We got $450 in the budget, don't we? Nope. We only have what? $400,000 left? So this idea of debiting encumbrance, crediting budgetary control, putting that debit to encumbrance against our credit, which was the appropriation, is an effective tool because it's preventing us from ordering more than we have budget authority for, right? Somebody said, hey, we want to order something for $430. I thought we had $450 in the budget. Sorry, you're too late. We've already committed what? $50,000 of that budget authority, and so now we only have $400,000 left, right? Okay. Now, when the thing actually comes in and we know the actual price, do we need this placeholder anymore? We do not. So what do? We simply reverse it. We credit encumbrance, debit budgetary control, and then we can go ahead and replace that with the actual expenditure. We debit expenditure, credit vouchers payable. When we enter that expenditure, now we know our budget authority is $399,500 because we are now considering that extra $500. Is that what happened? Okay. All right. So let's go ahead. You know, there's no reason to sit in the front of the class and pout. If you're going to sit in the pout, then don't sit in the front of the class. Okay. So you go ahead and you do what? You sit here and you. Let's look at just the. Let's look at the whole process again, because I'm going to go ahead and tee up budgetary control. Steph Curry's got nothing on me but looks, talent, and youth. Okay. All right. So what happens? You sit here, and we are going to do the journal entries, and I'm going to keep track of budgetary control here. I'm just going to keep track of budgetary control. So originally I did what? You don't have to write this down. It's already on the slides. Originally, I debited estimated revenue. I debited it for what, $500,000? I credited my appropriation for $450,000. And then I credited budgetary control for how much? $50,000 in this little example. So I'm going to go ahead and post that $50,000 credit to budgetary control with me so far. Okay. Then I ordered the printer, the world's most expensive printer. Okay. And when I did what? I debited. Let me tee up encumbrances too. Why not? I debited encumbrances for $50,000. I credited bud control, didn't I? For $50,000. And now it's running into my encumbrance. I credited budgetary control for $50,000. When I credited budgetary control for $50,000, I posted that over here. Right? When the goods came in, I did what? I reversed this, didn't I? Didn't I reverse this? So I went ahead and I would have debited bud control for 50,000. I credit encumbrance for 50,000. When I credit encumbrance for 50,000, is this zero now? Encumbrance is zero now, isn't it? Okay, because I don't need that placeholder anymore, right? So I zero it out. My encumbrance is zero. And I go ahead and I debit budgetary control for 50,000. So I still have the 50,000, whichever one you want to point to. I still have the 50,000. That was from the original budget at the beginning of the year, wasn't it? That I stuck there? Right? Now, at the end of the year, I will always reverse my original beginning of the year budgetary entry. I always reverse it. So if you look here, beginning of the year, which I also have written on the board, you debited estimated revenue, you credited appropriation, you credited budgetary control for 50,000, right? That's that credit right there. At the end of the year, I always close my budgetary accounts. I always close my budgetary accounts at the end of the year. So at the end of the year, to close them, I simply reverse what I had set up at the beginning of the year. Do you always close your revenue and expense accounts in accounting? Do you always close your revenue and expense accounts in accounting? Yes, you do. Good. Those are temporary accounts, right? Well, these budgetary accounts are all temporary accounts. None of them are going to be affecting balance sheet accounts, right? So they're all temporary accounts, so I have to close them at the end of the year. When I close them at the end of the year, I reverse them. I credit the estimated revenue. That closes that. I debit the appropriation. That closes the appropriation, doesn't it? And I debit budgetary control. And when I debit budgetary control, is it closed? Is it closed? Yes. So I could ask you a question on your exam. At the end of the year, what is the balance in the budgetary control account? You don't have to read any further. The answer to that is zero. Good. It is zero. Okay? So that's why it's not a big deal if we set up our budget for what we think we're going to spend, and then what? It comes in for a price that's a little bit different. We don't panic because we what? We're going to reverse that original budgetary entry anyway, aren't we? Now, sometimes students will say, well, wait a minute. What if you were way off on the budget? Isn't that a problem? And the answer to that is yes. Therefore, we better not be way off. Okay, we have to have good estimating techniques, and we'll probably leave ourselves a little cushion so that if it does come in a little bit different, we're not going over our budget. But it's not a big deal if we go a little bit to the left or the right on those budget numbers, right? Okay? Now, you come over, and let's go through this process again. You order the goods. What journal entry do you make? Everybody? Amen. Debit encumbrances, credit budgetary control, right? Then when the goods come in, you do what? Beautiful. Reverse for the original amount, don't you? Which is somewhat redundant. If you're reversing it, that means the original amount. So you debit what? Budgetary control for the original amount. You credit the encumbrance for the original amount. Thus wiping out the other journal entry, right? And then you replace that with the actuals. You debit expenditure. You credit vouchers payable for the actual amount, right? Okay, good. I'm going to be hitting you with a bunch of questions like that on your exam. What do you do when you order the goods? What do you do when the goods come in? Okay? Okay, good. Question. Really, right here, 1, 2, 3, 4, 5 important slides following that process. Okay, let's talk about the appropriation entry. Beginning of the year, you do what? Debit estimated revenue, credit the appropriation. Debit or credit budgetary control if it's a what? Surplus, meaning my estimated revenues were more than my appropriations. I have a surplus, I'll credit budgetary control. If my what? If my appropriations are more than my estimated revenue, I have a deficit, I will debit budgetary control to make that entry balance, right? At the end of the year, I simply do what? I simply reverse it, right? So all budgetary accounts are going to go to zero by the end of the year, aren't they? Both the beginning of the year and both the during of the year ordering. Okay, dual track, whatever. I'm tired of that slide. Okay, let's start this thing over again. Let's do another one. Okay, this government has a deficit, doesn't it? Because they have what? More appropriations than they do estimated revenue? Is this a mistake? They do this on purpose. They plan to, right? In some cases, it makes sense. In some cases, like, hey, we're in an economic downturn. We want to stimulate the economy. Let's do it. It's a little bit weird to do it when supposedly the economy is booming and you continue to have this deficit spending year after year, or you have deficit spending during periods of war. That's weird. I'll be dead before those chickens come home to roost, I guess. Either that or what all the young people will do is they'll sit there and they'll say, okay, you see all these benefits we're paying the old people? There's too many old people. So they're going to take us out into the middle of the desert and just let us go. Think it won't happen? I don't know. Okay? All right. I mean, that's what happens in other societies. When they see all these old people sitting around not hunting, yet they're sitting there eating the food, they say, come on, Pop, we're going to take you hunting one more last time. Gee, the lion ate Pop during the hunting. Okay, whatever. Okay. All right, so what happens? You sit here and you have what? You have this deficit situation here, right? So you debit the budgetary control for the deficit. Okay? Okay, good. Now, when we do our encumbrance accounting, which you already know now, we debit the budgetary control, credit the, we debit the encumbrance, credit the budgetary control, right? Okay, then what? Don't worry about subsidiary ledger. I'm not asking you about subsidiary ledger in here. When the goods come in, we do what? Reverse for the original amount and debit expenditure, credit voucher payable for the actual. Okay, good. Looks like you're getting this, guys, and this is stuff that a lot of people struggle with in this class, so that's great. I mean, it's really not much more than that. Okay, governmental activities, ledger, okay, this might be the fund level. It is the general fund level. Governmental activities, remember, we might call out our expenditures by function, by program, whatever. Okay, but don't worry about that. Really just worry more about this. But just do know that we have different classifications, government-wide versus fund, right? Okay, and we could have what? Differences in how we account for things under modified accrual versus accrual. There's no difference here. It's just classification difference is all they're showing you. Okay, accounting for payroll. The slide goes on a bit. I don't care about your ability to account for payroll. This is not accounting 100 or whatever, okay, or a junior college accounting class. So I'm not going to make you sit here and worry about payroll, okay? Do know, though, that when you have a recurring expenditure like payroll, you do not have to use the encumbrance. There's no way that the government's going to overspend its authority for things like payroll. They know how many employees they have. They know what they pay them, so they appropriate enough to meet the payroll, don't they? And then they just go on like that. Now, sometimes people say, well, what if they hire more people? Well, there's no such thing as accidental hirings. They don't say, hey, you, where did you come from? Well, I work here now. Oh, okay, well, we better pay you then, right? I mean, they know who they've hired. They know how much they're going to pay them, and they appropriate enough to meet that payroll, don't they? So there's no need to do the encumbrances for the reoccurring expenditures. It's those weird things that come up. It's that $50,000 printer that we hadn't originally known that we were going to have to buy that we want to use the encumbrance accounting for. Recurring expenditures we do not appropriate. I mean, we do not encumber, excuse me. There's an appropriation for it, but we don't encumber for it. Okay? And so just to look at this slide for our payroll, we debit the expenditure, and government employees do pay taxes, and the governments will withhold taxes that could then be remitted to the state or the federal government, whatever. Okay? Again, I'm not here to teach payroll accounting, but I do want you to understand that when one government owes another government money, we don't call it payable, we call it due to. When one government owes another government money, we call it due to. We call it due to. It is not accounts payable, it is not taxes payable, it is due to. And here, this city is owing money to the federal and the state government. It's called due to. And then, of course, they credit cash for the difference. That's the money that's going to the employees, right? And they're going to send that other money to the federal and the state government. Okay? It's called due to. That's why that's in red. That's why that's underlined. Okay, good. Government-wide, I should probably get rid of some of these. Again, we would just classify the expenses by function. Here is all they're showing us, by program function. So a different classification is all that's going on. Okay, good. Tax anticipation notes, TANs. Okay, TANs. So let me do one of my brother's dumb jokes my brother would always do. How you doing? Are you tan from the sun?
Yes.
Hi, I'm John from the earth. Okay, all right. It's never funny when he did it either, so it's his joke. Okay, I'll let him know that his jokes ain't making it anymore. Okay, he asked jokes like this. What did the farmer say? He does riddles like this. What did the pig say when the farmer grabbed him by the tail? This is the end of me. Okay, all right. So just think about those. All right. How come baseball players don't use bats any longer?
Because they flew off.
Okay, that's pretty good. Keep an eye on this guy. Okay, he's got an up-and-coming career in comedy, right? They don't use them any longer because they're long enough already. All right, so you take a look, and we have what? Tax anticipation notes, abbreviated TAN. Okay? And what happens? A government wants to borrow money on a short-term basis, and they will put up as collateral the tax money that's going to be coming in. Would you be willing to loan a government money under those circumstances? Yeah, because you know that tax money's coming in, right? So it's a way of them getting some short-term borrowing into the government that then will be covered by any taxes, the taxes that come in later. If it's a current liability, is it shown on the balance sheet of my governmental funds? If it's a current liability, is it shown on the balance sheet of my governmental funds? Yes, it is, because we have current assets, current liabilities, don't we? So just know that a tax anticipation note is a current liability and thus would be reported on the governmental fund balance sheet, general fund balance sheet, whatever. And of course, it's also reported at the government-wide level because government-wide has current and non-current. They call those tax anticipation notes. Okay, this slide is scary looking. It's not that bad. Okay, what we're doing here is discussing ways that money goes between funds. And there's 3 different ways that it can go between funds. Okay, you could have a loan between funds. You could have inter-fund transfers, or you could have a reciprocal transfer in which one fund pays another fund for some sort of service they receive. And that's going to be on the next slide. Okay, but let's just first look at the loans. Inter-fund loan affect the balance sheet. So if the general fund loans some money to the capital project fund, the general fund, and I'm assuming $10,000 here, would debit loan receivable $10,000, credit cash $10,000. Anything scary there? Just like commercial, right? And the what? The capital project fund, the fund receiving the money, would debit the cash and credit loan payable 10,000. How easy is that? That's simply a loan between two funds, isn't it? And it entirely affects the balance sheet. Now, if we have what we call non-reciprocal transfers, that means that the fund that is sending the money over is not expecting this money back. It's non-reciprocal, meaning it's not coming back. Okay? If that's the case, of course, cash will be affected on the balance sheet. Obviously, when that cash goes over, we'll credit cash, but then we'll debit other financing uses, transfer out 10,000. You already know this. We'll debit other financing uses, transfer out. I gave you that example a little earlier, I think when we were looking at chapter 2. We debit other financing uses, transfer out, don't we? Where does other financing uses show up? What financial statement does other financing uses show up? This thing is scanning for the answer. Where does other financing uses show up? Huh? Income statement. Good. What do we call the income statement? Statement of net position is the balance sheet at the government-wide level. Accounting is not a guessing man's game. What did you say?
Statement of revenues and expenditures.
And changes in fund balance. Good. Statement of revenues, expenditures, and change in fund balance.
Yeah.
If you shave your head, you can say it faster. Statement of revenues, expenditures, and change in fund balance. Okay? And drink a lot of coffee. Okay? Statement of revenues, expenditures, and change in fund balance is where we report our revenues, our expenditures, and then we have that bottom section in which we report our other financing sources, other financing uses, right? So we debit other financing uses in the general fund because they're the ones transferring the money out. That's going to reduce my fund balance, isn't it? Other financing uses reduce my fund balance? Okay, let's do this. We have a government, say a general fund. We have a capital project fund. First of all, you can also go join your brother. I know, well, they never liked each other. Okay. General fund, capital project fund. There we go. General fund. General fund has cash of 10,000. Has no liabilities. So its fund balance is how much? 10,000. Good. Capital project fund has no cash, no liabilities, no fund balance. Capital project fund asks its buddy, the general fund, for some money. So what do? We go ahead and we debit other financing uses. We credit cash, don't we? Right? Okay. So what happens? When we credit cash, is the cash zero over here? Cash is zero. And then we're going to prepare our statement of
Revenues, change in fund balance, and expenditures.
not necessarily in that order, but very good. Statement of revenues, expenditures, and change in fund balance, right?
Yeah.
Now, if this transaction that I wrote up here, this debit to other financing use and credit cash, was the only transaction this government had, do we have any revenues? If this transaction was the only transaction this government had, do we have any revenues?
No.
We do not. So our revenue is zero. If that transaction was the only transaction the government had, do we have any expenditures? We do not. Our expenditures are what? Zero. But then when we get down to the bottom section, we will report other financing uses, won't we? Of 10,000? Hello?
Yeah.
Other financing uses of 10,000, which is like a non-operating expense. Other financing uses. So my change in fund balance is going to be what? Is going to be a negative change, like a loss for the period. Negative 10,000 in the general fund. Right? Okay. Then I come to the end of the year, don't I? And I have to close all income statement accounts. I mean, that's not unique to governmental accounting. That's all accounting. You have to close your income statement accounts, don't you? So to close my other financing uses, since I debited it during the year, I'm now going to credit it at the end of the year. Other financing uses, transfer out for $10,000. Does that close it? Is it closed now? Is it closed now? I debited it here. I credited it here. It's zeroed out, isn't it? Which is what I want. And I have to debit something. I debit fund balance for $10,000, don't I? Now, if fund balance started the year with a credit of $10,000, and now I just debited for $10,000, how much is my fund balance? My fund balance is now 0, isn't it? And so when I go ahead and I report fund balance over here, it is now what? It is now 0. Does the balance sheet balance? Okay. Now in the capital project fund, now they have 10,000 cash, don't they? And they would do what? They would credit in the capital project fund. They would credit, where'd it go? Where is it? Other foreign financing sources. Debit cash 10,000. That's on the balance sheet. Credit other financing sources, transfer in. That's on the statement of revenues, expenditures, and change in fund balance. Now it's going to be the opposite, and then I'm going to have what? A positive change in fund balance in the capital project fund of 10, and when I close that out to fund balance will increase, won't it? So it's going to be a mirror image of what we did in the general fund. Right? Okay, so they call that non-reciprocal because what? That money is not coming back to the general fund. Capital project fund, I'm going to keep that money and spend it on something, right? Okay. Question? Okay, so we've got loans, really affects the balance sheet. That's counting 1, right? We've got what? These transfers affects the balance sheet, obviously for the cash, affects the statement of revenues, expenditure, and change in fund balance for the transfer in, transfer out, right? Okay. And then we could have what we call reciprocal transaction. With the reciprocal transaction, now the fund is going to receive a service in exchange for cash or whatever it's paying out. Okay? And so let's say that the general fund has to get some work that's going to be done on the police cars. So remember we said if it's what? Maybe a central motor pool. That's an example of internal service fund. And they'll charge the other funds for the services. So we take our police cars over to be worked in our central motor pool, and they charge us $5,000 for that work. If that's the case, we would debit expenditure, $5,000 in the general fund, and credit, and until we pay the cash, we would credit due to ISF is internal service fund. When one government owes another government money, or another fund money, when one fund owes another government money or another fund money, we credit not accounts payable, but we credit due to. So we've got the expenditure, credit due to internal service fund. In the internal service fund, the part I've highlighted here, we will debit due from general fund $5,000 and credit revenue $5,000 because they have provided that service, haven't they? Now, we'll talk more about the internal service fund later. They don't gouge them. They don't say, well, since you bring all your cars here and you have to charge us $50,000. They just try to cover their cost. They just try to cover their cost. So they charge them $5,000 for that service, debit due from general fund, credit revenue, right? So money's still going back and forth between the funds, but now it's for a service that was provided from one fund to the other. Okay. Now they put this fire hydrant over here because it could be that the water utility is providing water to the general fund. Hopefully that doesn't happen too much to put out fires, whatever. But governments do use water, don't they? Okay, so if that's the case, now the general fund again would debit expenditure for now $5,000 worth of water that was used. They'd credit now not due to internal service fund, but what? Enterprise fund. And in the enterprise fund, they will do what? Debit due from general fund, credit revenue for the $5,000 because now they've provided as an enterprise fund something to the governmental funds. And that can happen, right? Even though for the most part the customers of the enterprise fund are those outside of the government could still use water, right? Put out the fire in a house or something. Okay? Yeah, I don't think so negative. To put out a fire in an empty field, whatever. Okay? So we've had three different ways that money goes between funds, right? Either it goes from a loan, from a non-reciprocal transfer, or a reciprocal transaction like providing of a service, right? Question? Okay, good. Let's go ahead then and let's go and take a look at what happens if we have an encumbrance that is still outstanding at the end of the year. Can it happen? We order stuff in December of 2019 and the stupid stuff still isn't here at the end of December. We still have to close the encumbrance. We close it as though we received the stuff. But now we have to show that some of our budget authority is spoken for, and we're going to show that our fund balance is either committed or assigned. Remember when we have some sort of constraint on our fund balance, we have to say what? Committed or assigned or unassigned. And then it could be restricted if it's a covenant with the external source, or it could be non-spendable, right? Okay, so that's what we're going to do. We're going to go ahead and look at the whole process now of ordering the goods, well, setting up our budget at the beginning of the year, ordering our goods during the year, receiving some of the goods during the year, so accounting for our expenditure, having some stuff that we still haven't received, and then doing our closing entries. Okay, so I say see in class example, and it is on iLearn. It's called, not iLearn. Where am I? San Jose State. It's on Canvas, okay? And so you can see this on Canvas, but I also have it right here. I thought I did. It's called Chapter 4 in-class comprehensive example, okay? And we've got year 1, we've got year 2 going on here, okay? Now I think I can about fit this all on the screen, and it's helpful if I can lift the screen and kind of keep track of some T accounts as we go along here. So let me erase all this nonsense. Oh, I didn't give you guys, no, I gave you guys a break. Where's he going? Let me erase all this. Okay. Now I'm not going to keep track of every account, guys. I'm going to T account. I'm simply going to keep track of maybe I will. Let's tee up these as we go along. Okay, probably a little easier to follow. So beginning of the year, I get my budget authority. I estimate that I have revenues of $2 million. I get budget authority $1.8 million. Do I have a surplus or a deficit? I have a surplus, so I'm going to credit budgetary control, right? Let's set that one up first. For how much? 200,000? Okay. I have what? I have estimated revenue for, what is it, 2 million? And I have what? I have appropriation for 1,800,000. Just teeing these up. Okay? Okay, good. Then I go and I collect some revenues during the year. So I have what? I have actual revenues, and I collected them during the year. So it's meeting my revenue recognition criteria. I'm assuming this is available. I mean, is that we have the authority, and we have the what? Eligibility, and we also have what? We also have the time factor that we need to recognize revenue. Okay, so I go ahead and I debit cash and I credit revenue, and I credit revenue now for $2 million. I'm not gonna keep track of cash. Okay? I guess I could. What the heck? I'm an accountant. I should be able to do that. Debit cash for how much? 2 million? With me so far? Okay. Then what? Then I order some equipment. And I order $1.6 million worth of equipment. So when I order this equipment, I go ahead and I debit encumbrance for what? For how much? 1,600,000. And I credit budgetary control for 1,600,000. Okay. Now, if I were to go ahead and prepare an appropriations ledger right now, I would have a credit for the original budget. I'll have debit for encumbrance. I'll have credits for encumbrance, right? And then I'll have the balance. I'll have debits, I'll have credits, and then I'll have the, well, I don't need this extra credit over here. I'll have debits, I'll have credits, and then I'll have the balance. Okay? So let me move this debit over to give myself a little more room. So did I credit the appropriation for 1,800,000? Did I credit the appropriation for 1,800,000? Did I credit appropriation for 1,800,000? Okay. So when I credit that appropriation for 1,800,000, I now have a balance in here, credit balance of 1,800,000, don't I? Right? Then what? Then I go ahead and I have the debit to encumbrance, don't I? And when I enter that debit to encumbrance for how much? 1,600,000. I am left with budget authority of 200,000. Right? What happens if somebody comes in and wants to spend 300,000 on something? What do I tell them? Sorry, go find a cheaper widget, whatever it is you're trying to buy, because we're not going to have the money to afford a $300,000 one of those, right? Okay? Okay, good. Then what? Then 1,100,000 of the total order that I've ordered how much? How much have I ordered? 1.6. Only 1,100,000 comes in. Not the whole amount. 1,100,000 comes in of what at the price that I ordered it, but it comes in at a different price. It comes in at 1,300,000. Right? I haven't received the whole order, and it's come in at a price that's different than what I thought it was going to be, right? So what do? I reverse my encumbrance for the original amount, don't I? The 1,100,000 what I ordered it for. And so I go ahead and I credit my encumbrance for 1,100,000. There's still outstanding a balance of what? A balance of 500,000. Good. And I have what? And I have now a budgetary control. I'm going to sit here and credit budgetary control for 1,100,000. And now I'm going to go ahead and do what? I'm going to debit expenditure and credit cash for the actual amount, right? So when I debit expenditure, I debit that for what is it? 1,300,000. And I'm going to credit cash for 1,100,000. Excuse me, 1,300,000. Thank you, sir. 1,300,000. So I have a balance of cash left at what? 700,000 right now. Okay. So that's everything that happens during the year. That's everything that happens. Let's take a look at a couple things. I have what? I still have 500,000 of outstanding encumbrances, don't I? There's still 500,000 worth of stuff that hasn't come in. right? 1.1 million of my original encumbrance has come in, even though it came in at a different price. That much has come in, so there's still 500,000 that I've ordered that hasn't come in yet, right? That I'm expecting to have a price of 500,000. The stuff that did come in, I thought it was going to cost 1,100,000, but it actually cost me 1.3. That's all right, because I reversed out what I set up the budget for, and I put in the actual expenditure now, haven't I? So if I go back to my appropriations ledger over here, I'm going to go ahead and do what? I'm going to credit my appropriation for 1 million. Credit my appropriations ledger for 1,100,000. That's reversing that portion of that debit there that I put in. And I'm going to go ahead and do what? Debit expenditure for the actual amount, 1,300,000. And when I do, my budget authority is now how much? 0, isn't it? Right? I've used up all my budget authority. I had 200,000, and now some stuff is coming in at a different price, hasn't it? So that wipes out that budget authority. I had 200,000 to play with, but because my order price was a little bit off, that money's been used up now, hasn't it? So I've used up all my budget authority. Okay, so now I can go ahead and fix what this says, because this is wrong. This was in a previous life of this